Stock market crashes are frightening for anyone who owns stocks, and even those who don't will feel the impact. Job losses, foreclosures, bankruptcies, and business closures are all unavoidable consequences of market losses. Stress and emotions can be high, but it's critical to separate your emotions from your financial decisions during difficult times like these. Nothing is definite, but there are some things you can do to make the best of a bad circumstance and possibly profit in the long run. Many big-name investors have shown that those who have the patience to wait out periods of crisis emerge stronger than before. Don't be caught off guard when something like this happens, as if you anticipate the market to continue rising indefinitely. Instead, do the following to preserve and benefit your finances. Welcome to Cashflow Canvas, where we teach lessons about investment and money-saving techniques. If you want to make your financial future better, make sure to like this video and subscribe to our channel for the latest updates. Don't freak out. When the news is loaded with tales about stock values plummeting and unemployment numbers increasing, it's tempting to panic. Fear causes many people to cash out their investments and put some money under their mattresses. Uncertainty is a very short-sighted tactic, as is depleting savings by stockpiling items. Making judgments on the spur of the moment can often result in terrible conclusions that you will later regret. A stock market meltdown is unavoidable, and anyone who invests should be informed that their investments will lose value at times. Markets have always fluctuated dramatically up and down. Being prepared to see the value of your portfolio fall during difficult economic times will go a long way toward improving your emotional well-being. A crash occurs every 8 years or so on average, with the stock market losing 41% on average. If you have a $500,000 portfolio in a good market, don't be surprised if it drops to $300,000 or less in a bad market. Buying stocks entails both risks and benefits, and panicking at low prices is unproductive. Examine long-term trends. Investors can become so focused on short-term trends that they lose sight of the big picture. Elections, earnings seasons, and other bits of news are simply enlarged versions of what an investor will face over the course of his or her career. It might be frightening to see volatility interrupt your savings as your account balance fluctuates by thousands of dollars every day. However, looking at long-term trends and reminding yourself that the overall tendency is higher over the course of a decade might help you stay calm when things start to go downhill. The real estate and stock markets usually increase, and they always recover from losses, even during extreme times of gloom, such as the 10-year Great Depression. Concentrate on the broad picture and how your money will look in 5, 10, or 20 years. Start a side business. Most people rely on a single source of income to cover all of their expenses. When that one source is weakened or deleted, it can have a significant impact on your mental health. It's hazardous to rely on your boss signing your paycheck every week to put food on the table. They're likely to prioritize their own financial well-being over yours. Take on a side hustle if you don't already have one to supplement your income. This might be as simple as delivering pizza a few nights a week, babysitting on weekends, or finding a way to make money online. These should ideally be constructed before a market crash, but there is always opportunity elsewhere. An additional source of funding for your bank account is an excellent financial buffer. If your main source of income remains solid, your side income could be used to pay down debt or achieve other financial objectives. Establishing numerous income streams is critical regardless of the state of the stock market. It would assist to soothe your mind to know that you are not reliant on a single employment. One major benefit of a reduction in stock prices is the potential to purchase assets at a lower cost. According to Warren Buffett, stock market drops are rare occasions when quality enterprises can be found in the clearance section. As you invest the same amount every week, regardless of how the market moves, you can buy more shares of the same stocks as prices fall. Some may find it strange to buy when prices are low, but this is how the rich get richer, by purchasing reduced investments. If you have extra income, now could be a good moment to put it to work in the market. Investing near the bottom of the market would result in a 41% discount on average. It can be difficult to predict when the market has reached its bottom, but you can simply buy stocks whenever their prices have dropped. Consider how much money you'd lose if you sold your assets at a 41% discount, not to mention the penalties you would face if you remove from a retirement account. Boost your savings. During uncertain times, it is best to avoid splurging on significant items. This could involve deferring the purchase of a second car or vacation home, deferring the purchase of a high-end watch, or canceling some needless subscription services. If necessary, consider selling goods that you no longer want. Each market crisis has a unique economic consequence, with various degrees of intensity and duration, so it pays to be cautious, especially if you're in debt. Making a significant non-essential purchase, especially without adequate savings, might be disastrous. Increasing the gap between your income and expenses will provide further security against potentially reduced income. Maintain reserves. A common blunder is failing to keep enough money in a savings account for emergencies. An emergency fund is vital for not just growing wealth, but also for providing a critical component of financial security. Layoffs and job losses are possible and occur. Customers' willingness to spend money may result in lower sales at restaurants, retail, and services. This can be frightening, but it becomes much more bearable after sufficient funds have been created. Most experts advocate saving 3 to 6 months of expenses, but 6 months or more is safer during market cycles when a recession is imminent. These recommendations aren't just for individuals. Many small businesses fail because they don't have adequate savings and don't have enough money to cover their obligations during a period of income lapse. Keeping money in a savings account for difficult times will prevent, or at least reduce, the need to take on debt or withdraw from retirement accounts, if that is even an option. Examine your strategy. Everyone should have a long-term financial outlook. This contains important considerations such as when you can and will retire. Nobody appreciates unpredictability, but planning ahead of time will help you make the most of it when a market meltdown occurs. It pays to stick to your strategy and attempt to keep your emotions apart from your finances. Reduce when possible, be especially mindful of your income sources. Take on extra job if possible, and stick to your long-term goal. This will allow you to profit when others sell their assets out of fear. One of the worst things you can do is panic and sell everything because of fear and a lack of preparation. As we conclude, I'd like to thank you for watching. I hope you found value in this video and learned something new, and I look forward to seeing you in our future videos. I would deeply value it if you could like this video and subscribe to our channel. Your support will help us to create more valuable content, and we can work together to secure your financial future. What are the key takeaways from this video that you can share in the comment section?